2023 was a story about fiscal forces and monetary forces offsetting each other roughly equally. And if either one was winning, it was more the fiscal side. Bitcoin is, from my analysis, more correlated with liquidity than any other asset that I track. If you don't really think central banking is the best framework to begin with, it's hard to evaluate how they're doing. It's not just the Fed deciding how much money exists. They're working with the Treasury to supply it. So it's not just them that caused it, although they contributed to it. Now, once inflation came, they pivoted and they got very tight, and which is generally what they're supposed to do.
Lyn dropped some financial wisdom bombs, talking about the epic clash between fiscal forces and monetary might. It's like the financial Avengers fighting for supremacy. But guess what? Bitcoin is the rockstar in this show. More synchronized with liquidity than your favorite boy band. And hey, if you're not vibing with central banking, evaluating their moves is like watching a cat try to understand quantum physics. Tricky but oddly entertaining. Stick around, we got a front row seat to the fiscal circus. Now, let's continue our discussion with Lyn Alden.
2023 was a story about fiscal forces and monetary forces offsetting each other roughly equally. And if either one was winning, it was more the fiscal side. And what I mean by that is that, throughout 2022, the Federal Reserve, as we all know, was tightening monetary policy. They were raising interest rates, they were reducing their balance sheet, and most assets had a very bad year in 2022. So stocks had a big problem, especially growth stocks. Bitcoin obviously went down a ton. Most other assets did poorly. Normally in those types of environments, bonds hold up pretty well, but even they went down. And so pretty much across the board, if you were not in cash or a small select set of idiosyncratic investments, just about everything went down. But by early 2023, we started to see a little bit of a reversal. In fact, it kind of started in late 2022, which is basically that the Treasury began offsetting some of that Fed tightening. And so throughout 2023, the Federal Reserve has still been tightening. Rates are ending the year higher than they started. The Federal Reserve's balance sheet is lower than it started the year. So the Federal Reserve has, even though they've decelerated their course of tightening, they still are tightening. But what's different about kind of late 2022 and all of 2023 compared to the first 3 quarters of 2022 is that the Treasury is offsetting it, and they've done that in 2 primary ways. So from the fourth quarter of 2022 through the first 2 quarters of 2023, so that kind of 8-9 month period, they were drawing down their cash balance and pushing it back into the market. Partially that was because they had too much cash above their target, and then it accelerated because of the debt ceiling. So rather than emptying some of their cash into the financial system, they had to empty literally all of it up until the end of May of this year. And then the second stage was that the Treasury then had a choice. If they went back to normal operation, you'd have the Fed tightening and there'd be no offset. And we probably would have had a second stage of liquidity crisis. Instead, the Treasury said, okay, we're going to issue a ton of short duration bonds, T-bills, instead of the longer duration, or basically the overall ratio of debt issuance is going to be very much skewed abnormally much towards that short end. And what that did was allowed money that was sitting in the reverse repo markets, which is, for lack of a better word, it's kind of money that's like excess demand for T-bills. It's like excess cash that's sucked out of the banking system. It's kind of parked at the Fed, but not owned by the Fed. It's parked at the Fed. And issuing a ton of extra T-bills allowed that capital to come in back into the financial system. And so that was another lever that the Treasury pulled to offset the Fed's quantitative tightening. And so, for example, bank reserves are not any lower now than they were in the banking crisis. That kind of stress tested their lower end. And almost a year later, 10 months later, bank reserves aren't any lower, even though the Federal Reserve has still been tightening. And that's because the Treasury has used these other offsets to offset it. And so basically the story over the past 2 years was, 3 quarters of tightening overall, Fed tightening, and kind of a neutral Treasury, and then about 5 quarters of roughly balanced Treasury and Fed actions. And so various global liquidity measures are higher now than they were in kind of the worst point, which was late 2022. And Bitcoin's price action and many other risk assets price action tends to be highly correlated with global liquidity. And it also just so happens.
Well, let's highlight some of what Lyn said. The financial saga of 2023 is a roller coaster ride you won't want to miss. Picture this. In 2022, the Federal Reserve will tighten its grip on the monetary reins, raising interest rates and squeezing its balance sheet like a financial vice. Stocks were stumbling, Bitcoin took a nosedive, and even bonds felt the tremors. It was like a financial storm, and if you weren't holding cash or some secret investment magic, you were in for a wild ride. But hold on, by the early echoes of 2023, a twist in the tale. The Treasury decided to be the unsung hero, countering the Fed's tightening moods with some slick dance moves of its own. Imagine them drawing down their cash stash, tossing it back into the market like confetti and saying, "Let the liquidity party begin." Then, like a DJ dropping the hottest beats, they flooded the scene with short-term bonds, luring cash back into the financial fiesta. So here we are, witnessing a dance of financial forces. The Federal Reserve is still doing its tightening tango, rates are higher, and the balance sheet is slimmer. But the Treasury has donned its dancing shoes, twirling around with cash and short-term bonds, ensuring the show goes on. Bank reserves are holding their ground, and global liquidity is soaring higher than a SpaceX rocket. It's the financial Cirque du Soleil, and you're right in the front row.
If you don't really think central banking is the best framework to begin with, it's hard to evaluate how they're doing. In terms of following their mandate, I think they're doing a fairly good job, at least in the past couple of years. I think they made missteps in 2020 and 2021 by not anticipating that inflation would come. I think they basically underestimated the quantity theory of money. The supply of money is not the only factor in inflation, but it's a big factor for inflation, and they severely underestimated it. I think their models were wrong, their theory was wrong, and they got punched in the face basically because of it. They got embarrassed. Now, not all the inflation was their fault. A lot of it was the fiscal authority, right? So it's not just the Fed deciding how much money exists. They're working with the Treasury to supply it. So it's not just them that caused it, although they contributed to it. Now, once inflation came, they pivoted and they got very tight, and which is generally what they're supposed to do. In that, they basically wanted to curtail credit growth. They wanted to curtail speculation. They wanted to bring down asset prices because that helps reduce demand and therefore get back to a supply-demand equilibrium, which can help get prices down. I think the big challenge that the Fed faces is that a lot of this is outside of their control. Their tools are mainly around basically adjusting the level of bank lending. So there's really two main ways that broad money comes into existence. One is very large fiscal deficits are run and monetized by the central bank and the broader banking system. And number two is that banks decide to lend for various reasons. And for example, in the 1970s, most of the money supply growth was from bank lending. In the 1940s, and then again in the 2020s, these were other inflationary environments, most of the new money creation was not from bank lending, it was from monetized fiscal deficits. And the problem is that the Fed has no control over fiscal deficits. Their main tools are kind of built around the assumption that bank lending drives most money supply growth. And so they can slow down the rate of bank lending, which they've done. They can damage the wealth effect to varying degrees and therefore slow down spending, which they've at least for a while it was working. But their tools can't really address fiscal, which is the primary driver of inflation in this cycle. So given the tools they have, they're kind of following the textbook of what they should be doing. So it's hard to give them too bad of a grade, even though I think the whole model is challenged and antiquated. I mean, I really wrote a book called Broken Money to kind of bring attention to how this is very outdated tech. But I guess the people managing the tech are, doing a decent job of it, at least ever since they pivoted.
Now, let's talk about our financial maestros at the Fed, the Avengers of economic stability, or so we hope. The story kicks off in 2021 with a bit of a hiccup. Inflation decided to gatecrash the party, catching everyone off guard. It's like the Fed ordered a quiet dinner, and inflation burst in, uninvited and hungry. They got a bit red-faced, maybe a little embarrassed, because their models and theories seemed to have missed the memo. But fear not, our heroes pivoted. They tightened their belts, cooled off credit growth and tried to bring down asset prices, a bit like trying to cool down a potato without burning your fingers. The challenge? A chunk of the inflation mess was not their doing, but the fiscal authorities' handiwork. It's a bit like blaming the chef for a dish gone wrong when the kitchen is in chaos. Now, here's the tricky part. The Fed's toolbox is like a Swiss Army knife in a gourmet kitchen. Useful, but not for every dish. They can control bank lending, but fiscal deficits are a wild card. The real question, can they tackle the inflation beast with these tools, or are they just playing the hand they were dealt? The Fed might be working with outdated tech. They're playing the game fairly well since their brand pivot. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.